What does a 450 parts per million scenario look like from an emissions trajectory perspective? Tons of variation there, and that's at the global level. Bring that back to the local level, provincial level, national level, the uncertainties are huge. But what we do have is still this view that at some point low carbon goods and services are going to be a much more important part of the global economy than they are today. And you have these numbers all over the map, and I put them up here, but they're essentially meaningless numbers for some of the reasons we heard earlier, but it depends on how wide you cast the net, depends on what you count as a low carbon good and service, but from a national perspective, what really matters to us are more detailed questions. What are we going to be really good at producing? What are our domestic policies going to encourage? What are global policies going to encourage and discourage vis-a-vis what we are most well-suited to produce? So I'm going to skip over these pretty quickly and try to get this. So what do the models say that's in common? The general conclusions are all really similar. Right, we're going to see decarbonization of global energy supply, rapid decarbonization of electricity. We're going to see a change in our use of liquid hydrocarbon fuels, et cetera, and this huge deployment of low carbon technology. But most of these models rely on a very particular assumption that I think matters in this context. They rely on these coordinated global, usually carbon price or carbon trading policies that are probably very different from what we're actually going to see, and that matters for thinking about Canada in a low-carbon world. So what are these issues for Canada? Well, I think you can divide them in half. You can divide into global issues and domestic issues. So the first thing is, what are these global policies going to look like? And how are these policies going to affect the markets for the things we make now and the things we could potentially make, the products over which we would have a global comparative advantage? But then the second question is our domestic policies. What are those domestic policies going to look like? And in particular, Catherine's talk on emphasizing what are the political drivers for those policies, what industries are going to get favored, what technologies are going to get favored, and how become very, very important at the domestic level. So here are my first set of questions. I have a bunch of questions to motivate you today. First thing is, what are Canada's comparative advantages with respect to low-carbon technology? So what are the things that we are going to be good at producing? Second thing, what does the future hold for Canada's other resources? So not just our high-carbon ones, oil sands and natural gas and coal, but also things like uranium, potash, et cetera, from which we're used to harvesting rents. And then the third one is, to what degree should Canadian policy be altered, as well as our role in global policy development be altered with a view to capturing those rents or capturing quasi-rents? So, Commodore 64. Why am I going to tell you about this? I was at a conference in BC a few years ago, Clean Energy BC, talking about feed-in tariffs. And a woman stood up and she said, well, if we all listened to economists like you, we'd all still be using Commodore 64s. We need to deploy green jobs now to develop an economy around these new technologies, et cetera. So I looked at her, I said, well, do you know the history of the Commodore 64? And she looked at me like a deer in the headlights. I'm in trouble. And the reason why she was in trouble in this particular conversation was that the Commodore 64, well, Commodore as a company actually used to be located in Toronto. It was founded in Toronto. And it was for a long time headquartered in Toronto, and for a long time made relatively limited contributions to technology through things like calculators. But they had a huge breakthrough through their personal computing, the VIC-20, the Commodore 64, onwards to the Amiga. The problem for Toronto's economy with that was that by the time they had this massive breakthrough, well, they had already relocated. And I have California on here, but actually the owner had relocated to California, the production center relocated to Pennsylvania, and for tax purposes they were located in the Bahamas. So you had a company which was a great technological development, is still probably the most successful personal computer ever sold, headquartered in Canada, great technology story, except when it actually hit, it was gone. And that, I think, emphasizes one of the key differences between a low-carbon economy and what we think of in resources is mobility. Mobility of capital, mobility of people, mobility of technology. You can take a patent just about anywhere. It's much more difficult to take the oil sands with you and relocate to the Bahamas. So what is our comparative advantage? I think the real question we need to ask are, what are the things that we can produce, not at the lowest cost of production, but the lowest opportunity cost. And that distinction is really important when you get into talking about governments acting to encourage production. We can make anything cheaply in Canada. We could have Canadian-made televisions in all our homes. They'd just be really expensive to make. They might not have a really high price at the cash register, but we'd have to deploy significant resources elsewhere in the economy to produce them. I'm going to move ahead. So I framed this already, but what are Canada's comparative advantages, true comparative advantages in terms of the technologies the world and our domestic economy are likely to demand? That's my research question number one for you. Second thing I want to talk about are Canada's resources in a low-carbon world. So if you look at projections like the International Energy Agency's 450 ppm scenario, what you'll see is huge decreases in coal, large decreases in oil, and relatively small decreases in natural gas consumption. But we tend to focus on those quantities. Oh my goodness, oil demand is going to drop by 20% by 2035. That's a big problem for Canada. Well, let me rephrase it another way. The IEA's 450 parts per million scenario says that the world is going to use 76 million barrels a day of oil at $100 a barrel in 2035. What's Canada's share of that? What should Canada's share of that be? How much should we fight to get it? And so let me show you a wonderful graphic here from my RA, Kirsten Smith. But let me show you the difference. And these are two IEA scenarios, and there's two things I want you to pick up on this graph. First of all, under the IEA's current policies scenario, the one most often cited by our politicians, these are bitumen prices. Bitumen prices go up to about $129 a barrel over the life of an oil sands mine like Fort Hills. Under the 450 parts per million scenario, they're down to, well, not quite half of that, $76 a barrel. So a huge change in the per barrel revenue happening at that oil sands project. But what I want you to remark on is the bottom line. The bottom line, which shows the project's internal rate of return. And the project's internal rate of return under the IEA 450 scenario is 14.2%. When Suncor came forward with this project under the assumptions they currently use, they had that project as a 13% rate of return. So let me put that to you in a different way. Under the IEA's 450 parts per million scenario, using a model similar to what Suncor would use to bank this project, the rate of return on a new oil sands mine is higher than what Suncor claimed for its investors. Why? Because of the underlying price of oil at $100 a barrel. So the key question for our domestic resources is that question of price. What are global resource prices? And I use the example of oil sands, but this goes across our resources. What are resource prices for our traditional areas in which we do have comparative advantage likely to be, and how is that likely to play out? And so I think research questions 2 and 3, framing that, what are these prices likely to be? And this is a real challenge for modeling, and I had this conversation with Mark Jackert a couple weeks ago in Vancouver, where he's pulling together some data on this to try to get a sense of these price impacts. And I'm going to misquote him, but the range of prices that he gave me was somewhere from the hundreds of dollars a barrel to the tens of dollars per barrel, or $10 to $20 per barrel for oil prices in 2035 under a 450 parts per million scenario. That matters a great deal if you're in Canada sitting on roughly 2 trillion barrels of oil sands. And the second question that I think is related to this is, what does this imply for Canada's engagement in climate change policies globally? Climate change agreements. How do we want these agreements to be framed to not only to accomplish dual goals? One is to accomplish global goals on a climate change mitigation perspective, but the second one is to obviously preserve national interest in terms of the value of our, I believe Stuart used the word natural capital, so I'll use it here in this context as well. The last part I want to highlight, and it's related back to the story, is a question of rent. So I talked about Commodore 64 and the portability of technology, in some sense, the inability to earn locational rents from technology. The fact that we can make something here today does not necessarily mean we're going to be the cheapest place to make it tomorrow. And I want you to think about how much our economy relies on resource rents today, and the question of how is it that we're going to replace that. So we've heard a lot of people talk already today about two measures of the economy. We've heard people talk about jobs, and we've heard people talk about GDP. Well, both of those don't actually get to the question of what money do we have at our disposal to spend on the things we want to buy. And those might include education, healthcare, whatever you want them to be. And one of those determining factors there is going to be what's the fiscal capacity, what's the ability to raise tax dollars and or royalties from these new technologies. Do the same models exist in this low carbon economy, or are we dealing in economic activity with less fiscal room? So I'm going to go back to my Alberta examples just because I think that they illustrate an interesting point. This graph shows Alberta's resource revenues over the last couple of decades, but there's something that's really interesting in here, and I think it's the trade-off between natural gas and oil. So when I moved to Alberta, we were right in the middle of the natural gas boom in the early 2000s, and so you can see the bottom wedge, the light blue, rising really quickly through the 2000s into the peak a little short of the 2008 crash. So you had a situation where natural gas revenues made up a significant proportion. You're looking at almost $10 billion a year in natural gas royalties alone. Those are down below $1 billion a year right now due to a change in technology, essentially. And so the first point is, how many provinces could withstand that type of a removal of fiscal capacity from their economy? Alberta was able to weather it basically because of the coincident rise of the oil sands, which do in some ways benefit from cheaper gas. So a lot of that natural gas royalty revenue has been effectively replaced by oil sands royalty. But the reason why I want to show you this is to have you thinking about, well, okay, when we talk about a low carbon economy, there's a lot more than just jobs and GDP. There's also a tax revenue, government revenue side to the equation that we want to think about. It's not necessarily the case that there's less revenue there, it's just a topic we want to discuss. So I'm going to go back to my barrels for a second just to highlight a couple things. We tend to think about carbon policies as affecting profits of oil companies, and that's true, but what I want you to look at is the purple region. So under the current policies scenario from the IEA, you're looking at an average per barrel of bitumen tax and royalty share of about $53 a barrel. Under the IEA 450, that drops in half. So yes, the developers get hit, drops by more than half. Yes, the developers get hit by stringent carbon policies or drops in global demand, which is both are happening in this scenario. Drops in global prices relative to the baseline scenario, but there's an important hit on fiscal capacity as well. So I guess my remaining questions in the minute I have left, to what degree are rents likely to be earned on the technologies in which we possess a comparative advantage? So there's two filters there. One, do we do this well? Two, are we able to collect rents from it, or is it sufficiently portable that it's going to move if we try to extract rents from it? Second, to what degree are existing resource rents likely to be annulled or redistributed through global carbon policies? And then the third one, which I keep coming back to what extent can Canada influence the share of either the rents from new low-carbon goods and services and technologies or existing rents from existing resources in an altered market, a market altered by climate change policy. So with that, my time's up. So contact information as follows, and thanks very much for your attention.